All right, everyone, let's begin. I think a few more people are still coming in slowly, but we are going to record this session so you guys have a copy of this later on, and we'll be sure to email it to you. Good evening, everyone joining us from India. My name is Kabir Israni, and I am the founder and CEO of Raveum. For those of you who have invested with us before, welcome back. For the new faces in the room, Raveum is the market leading gateway connecting global capital to top tier US real estate. We specialize in making cross border investing completely frictionless, whether it's entity formation, tax considerations, or compliance structure. We handle all the heavy lifting behind the scenes. And to ensure you have the white glove support, our entire India investor relations team is on this call tonight. They are your local boots on the ground, operating in your time zone to make this process seamless. At the end of this call, I'll be sure to introduce them to you so that you may also have a one on one with them. But for the main thing, today we are here to walk you through a highly compelling multi-family investment opportunity, Chapel Run Apartments. I will be setting the stage on the structure, our return drivers, the key risks, and the upside. After that, I will be handing it over to our co-host and operating partner, Julian Vogel from Colony Hills Capital, to walk you through the specifics of the assets. Now, Colony Hills Capital, as I'm sure all of you already remember, is someone we partnered with before. So I'm very, very excited to actually have him on the call here today. So without further ado, let's jump right in and begin. This deal is now live on the Raveum investor application and the mobile application. So if you log in today, make your accounts and get activated, you will be able to see it just like you see it on my screen. Let's dive in straight into the numbers. What you're looking at is Chapel Run, located in Georgia. It is just a 20-minute drive from downtown Atlanta. The targeted raise is $7.2 million. We're trying to recapitalize an existing 172 unit asset. For our Indian investors, I want to briefly translate a few of these US market terms before I hand over to Julian so that we're all on looking at it from the same financial model. The yield and multiple, we're projecting a 16% net IRR and a 2.10 equity multiple. This is modeled over a standard 5-year hold period with an assumed 5.75% exit cap rate. But all that is irrelevant. Simply put, we're aiming to nearly double your invested capital over 5 years. The net operating income lift, that is the real value created. Through targeted operational changes that Julian will speak about, we're projecting a massive $440,000 NOI uplift in just year one. And the beauty of this is risk mitigation. This deal has already done all the physical heavy lifting. The sponsor, Colony Hills Capital and Julian, have already invested approximately $1.16 million in capital expenditures since 2021. This property is already 95% leased. The upside here is purely about optimizing management, reducing controllable expenses like payroll and maintenance, and allowing us to capture 5% rent increments. Now, do not forget, as Indian investors, you have the upside of foreign exchange, and you do not see such high cash on cash on your local deals. And that is the quick context I want to cover. To walk you through exactly how we execute that on the ground, I want to officially ask Julian Vogel, that represents Colony Hills Capital, to give his piece of the puzzle. To give you an idea of their pedigree, Colony Hills has acquired or operated 37 properties across 9 states, totaling over 12,000 apartment homes and almost $1.3 billion in capitalization. They know this asset class inside and out. So, Julian, thank you for being here, and please take over.
Thanks for having me, Kabir, and thanks for the intro. I'm going to share my screen.
Hi.
Can you guys hear me okay?
Yep.
Okay, great. Just make this full screen.
Am I audible?
Yes, you're audible, Mr. Datta. Hey, Julian, before you jump right away, I do want to note that I already mentioned our Indian-based investor relations team and operations teams are on this call today. They will be actively monitoring the chat. So if any questions come up during the call with us today, feel free to drop them in there, and that team will be able to address them in real time. And then we'll give Julian a chance to go through them as well. You will also notice a Google form is pinned at the top of the chat. So whenever you have the time, take a quick moment to fill that out so that we can register interest and ensure our team follows up with you directly afterwards. Take it away.
Sure thing. So I'll just give you a little background on myself and Colony. Kabir already touched on it. Glenn started the firm in 2008 as a family office venture for himself. He comes from the manufacturing background, and he had a significant capital event in the 90s and then got into venture capital. And one of the firms that he started was Colony Hills. I joined 7 years ago, roughly, as fund manager and also to manage our capital markets. So basically anything and everything capital on a deal by deal basis, also investor relations and our fund strategies. And Kabir already mentioned our pedigree and our track record, 12,000 units, about 1.4 billion of total capitalization up and down the East Coast. We purchased this deal in 2021. This deal is what's called a LIHTC deal, low income housing tax credit deal, which is an affordable housing deal. It looks and feels like a regular multifamily property. The only difference between this property and the one down the street that's market rate is our rents are tied to the average median income in a radius around the property. So that average median income is the average of what households earn in this area. The rents are tied to 60% and 80% of that average, okay? So as that income goes up every single year, our rent ceiling also goes up. So when we purchased this property, the seller was the original developer. He had used tax credits to develop this property. It was a beautiful property, did not require a lot of renovation dollars. As Kabir mentioned, it was only 1.16 million. And I'm going to go into where that 1.16 million went. But since we've owned it, occupancy has only gone up. I think when we purchased it, it was about 90% occupied. Right now, it's 100% leased, which is incredible. But there's a few value-add features for this deal that are very simple for us versus other opportunities maybe we see. That I'm going to also walk you guys through. I also, Kabir, unless you disagree, I would like to pause after I go through each slide because I really want to make sure that everyone listening understands everything that I'm saying, because sometimes I can use market lingo that maybe some listeners might not be familiar with. So please, I'm going to pause after each slide. If the Raveum team wants to shoot out any questions, clarifying questions, I'm happy to field questions as I'm going through the presentation. Okay, so I should have made that disclaimer to start.
No worries. No worries.
So it was built in 2000. We will be refinancing the debt on this property. Right now we have a loan that we're going to be refinancing, putting 5-year fixed rate debt on at a 4.77% interest rate. There's 172 units. I'm going to go through the location as well. It's in Decatur, Georgia. As I mentioned, it's already 100% leased, excuse me. And since 2021, when we purchased it, we've driven the gross income from $2,072,000 to just shy of $2.5 million. So we've already done quite a bit of value add on the operations. However, with a refinance, I'm going to explain how, and with just with the refinance, really, we're going to be able to add $450,000 of income to this property, as well as switching property management. And that might sound unbelievable, but I'm going to explain how that's possible. So before I do, just some images of the property. This is the clubhouse. When we purchased it, the clubhouse was being used as an after-school program, but it wasn't being used. It was an empty space except for the leasing office. So we put in a fitness center. We made a game room, added new signage. And there's 4 different unit types at this property. 1-1s, 2-2s, 2-bedroom, 2-bath, that is, 3-bedroom, 2-bath, and 4 bedrooms, 2 baths. Importantly, we're one of the only properties in the market with 4-bedroom, 2-bath unit mix. So we also appeal to the families. And here's the location of the property. So it's just 10, 15 minutes east of downtown Atlanta in Decatur. It has retail. It's right next to Interstate 20, Kroger's, right? Fitness center, Planet Fitness. So it's in a great location. Tenants have access to basically everything that they need. And the housing prices in Atlanta on average are about $500,000, and more usually north thereof, more likely around $800,000 to $1 million plus. And here's the rental comps. So this is our property, Chaparral. These are the comparative properties in the market. You can see where our rents lie within the comp list. And as I mentioned before, which is important, we're one of the only properties with 4-bedroom units. Okay, and here's the meat and potatoes of what I wanted to discuss with you guys. In a 1 year's time, we're going to be able to increase income by $500,000. How are we going to do that? Right now, we are using a property management firm. I'm not going to mention the name, who we would like to replace. We wanted to replace them about 1.5 years ago. Our current joint venture partner, institutional firm, has prevented us from replacing the property management firm. Why is that? Our partner has invested out of a fund that has a specific term. It's come to the end of that term, and they now want to sell this property. In their minds, if we were to switch property management, it could potentially create a detriment to the occupancy. And so to preserve the occupancy, they prevented us from firing and replacing our property management company. Now, why would we want to fire and replace our property management company? Because what we've discovered after being with them for 1.5 years, 2 years, is that they don't have the footprint and the resources in the market that we originally thought. For typical turnover of the units, that's when a tenant leaves and a new tenant comes in. There's turnover repairs, right? Maybe there's a hole in the wall, maybe it needs to be painted, maybe an appliance needs to be repaired. Typically, you'd have a individual on staff at the property or a team who's able to go in and fix up the units and make it ready for a new tenant. This property management company does not have that. They've had to outsource subcontractors for those simple turnover make-ready expenses. And that's driven our repairs and maintenance, that's what this R&M stands for, up to $307,000. And you can see just by replacing the management company, we'll be able to drop that by almost $200,000 just by having the right team, the right staffing at the property, the right maintenance staff, that is. The other thing is just for work orders. Anytime a tenant complains, maybe their air conditioner stopped working or their toilet needs fixing or whatever it might be, typical maintenance faults that take place, they have to bring in a contractor every single time that happens. So obviously that's very expensive, but thankfully it's also a very easy fix. So that's going to create $500,000 of savings just by replacing to a property management company that has more resources, more of a footprint in the Georgia area. We already have a company selected. They're called Meridian Management. We're very excited to make that change. The other change that's going to happen is we're going to be refinancing our debt. So this is our in-place debt. It's $15.37 million. We're going to bring that down to $13.5 million. And by replacing the debt, our current debt partner has required what's called an interest rate cap sweep. So our current debt, which we're going to be refinancing, is a floating rate loan. It's a variable rate loan. So to prevent the interest rate from going too high, our lender has required us to purchase what's called a rate cap from a third-party source. This third-party source sets a ceiling on how high our interest rate can go. That costs money though, obviously, because you're manufacturing a ceiling. And because it costs money and there's a term associated, our lender has required that we sweep net cash flow from the property into a reserve to purchase a rate cap when it expires. But the amount that they've required us to sweep is way in excess of the actual value of the rate cap. So what we're going to be doing is refinancing this debt with fixed rate, 5-year term debt, low leverage, and that rate cap sweep that I just described to you. I know maybe it's gone over some heads here because it's a sophisticated financial instrument, but by removing that from the stack, from our capital stack and from the deal, and by putting in place fixed rate long-term debt, we remove that sweep from the free cash flow. And so that's how we're going to be able to, I'm just going to jump back a couple slides here. That's how we're going to be able to drive our cash flow from a year one expected net cash flow of 570,000 all the way up to $1 million when we sell in year 5. Okay, so just to reiterate, because I know some of that was maybe a little complicated. So the first thing we're going to be doing is replacing our property management company. In so doing, we're going to bring down our typical repair costs because now we're going to have a more traditional maintenance staff in place. And the second thing we're going to be doing is we're going to be refinancing our debt, putting fixed rate debt in instead of floating rate debt, and that will remove that required cash sweep. Both of those simple fixes are going to drive up our income here. And the last piece I want to talk about before I jump into the returns and break that down for you is, if you remember at the beginning of this presentation, I mentioned that this is what is a LIHTC deal. This is an affordable housing deal. Well, those affordable restrictions also have a limit. They expire in 2031. So when we go to sell this asset in 2031, really in 5 years, we'll have a buyer pool that is now looking at a property that's going to have free market rent. There isn't going to be a cap on the rents. And so we're going to have buyers that are going to look at this property and say, okay, I get a property that requires basically no CapEx, no renovation dollars, because we being the seller have already renovated the entire property, nearly 100% occupied, expenses reduced. So they get a turnkey property and inherent value add. What's the inherent value add? That they can now adjust rents from a rent restricted affordable housing rents to market rate rents, which are, obviously limited by what the market will pay, but certainly higher than affordable rents.
I think, Julian, over here, I just want to take a quick second to step
Sure.
in.
Yeah.
To all the investors on this call right now, partners and everyone else, this is not a very common thing that we get. We don't get deals very often that we can present to you guys that have an edge to them. This is the inherent edge, that the rent restrictions, when we go to sell this deal, will no longer be there. That means at the end of the day, when we have to sell this deal, the number of applicable buyers are going to increase. And we can actually go ahead and bump that rent up to whatever amount we need to be for a free market rent. Now, Julian mentioned this property is 95% occupied, right, Julian? And was also mentioned was that every year, even though the rent has been tied down to the median income, it has still increased. These are not common features of a deal. So this is, by my virtue, the best deal Raveum has ever presented to you guys so far. So Julian, I just wanted to mention that was a very, very important part of the presentation. And one investor had a question here that I think it might be good to mention.
Sure.
Is that Mr. Sanjay had asked, what are the points of outcome? So I think Julian has already adaptly mentioned that reducing the operational expense is number one. Number two is holding on to the deal to the rent restrictions sellout. And number three, there is no CapEx left. So that is pretty much the only little risk that we have in this deal is going to be managing those three factors. So, Julian, do you want to add anything to that question, or do you think I answered that pretty well?
No, that's spot on. That's spot on. I did just stop sharing because I want to show the return. I want to break out the returns for everyone listening. So, and I have to do that through a different slide. I apologize for having to switch slides here.
No worries, no worries. There's also another question, a couple of questions in the chat that were talking about Colony Hill's work, past work, and track record. We have linked that track record in the chat right now. So feel free to download that. And as you fill in the Google chat form as well, we'll follow up with the information that you requested as well. And Julian, could you please start with the equity stack and that you were at? There was a question of clarification about how the equity stack came up. The question.
Yes, sure.
Yeah, what are total deal value, equity, debt, management fees, so on and so forth, entry and exit cap rates as well.
Okay, so exit cap rate is 5 3/4 in a 5-year horizon and 5-year term. That exit cap is actually very conservative because buying 2000 or newer multifamily real estate in Atlanta right now is typically between a 5 to a 5.5 cap. So our exit cap rate is actually conservative. So the returns we're talking about could easily be much higher if we end up selling at a 5.5 cap or a 5 1/4 cap rate in 5 years from now. So we feel really good about that. And I just want to say also for this investment, worst case, if we're not in a position to sell sometime between now and the next 5 years, we can just refinance and continue to hold this asset because the debt will be lower and it's already conservative leverage. So there's really no risk from a refinance standpoint. I just saw another question come up, Kabir.
Yeah, I'm just reviewing that myself. There was no additional question. You're good to continue.
Okay. Something to do with the debt and equity?
Oh yeah, so the question that you were answering right now, there was what's the total debt, what's the total equity? Once I think you are showing that on your screen right now. The next question was what is the, I think once we get to the returns, we can answer the last 3 questions over there.
Okay, sure. Okay, so the total raise, as Kabir mentioned, is 7.2 million.
Yeah.
The net IRR is 16% with a 1.96 multiple. So that someone puts in 100K, inclusive of distributions and their share of the sale proceeds would be 196,000. Right, so that's what that 196 means. The average yields for investors is just shy of 7%. Mm-hmm. And these returns are after a performance fee for Colony. So Colony has structured a 70-30 split over an 8 IRR. That means after all investors achieve an 8 IRR, meaning return of their capital and an average internal rate of return of 8%, any and all proceeds left to be split are split 70-30, 70 to the investors, 30 to Colony as a performance fee, as a carried interest or a promote.
Correct. And this, by the way, just to verify with everyone, does not include the foreign exchange gain that is applicable for people investing from India. Please do note that you're investing using Indian rupees. The rupee structurally depreciates about 3 to 4% a year. So these returns may be compounded by that factor. Please continue on, Julian.
Sure. So you can, I'm just breaking out the 6.94. Often investors get confused by what that average looks like. So here is the schedule of yields, projected yield to investors for the 7.2 million. And then here in year 5, you have the sale, which is the share of sale proceeds going to the 7.2 million. And you have all of that totaled here.
Okay. Yeah. And you'll have a copy of this deck emailed to you, and it's also live on the platform and the application right now. So you have a single source of information. Just download the Raveum app or log on to your portals. The deal is live over there.
Okay, that is the presentation. I'm happy to take questions now.
Thank you, guys. Thank you, Julian, first. There are a couple of questions. One of them is Priya. Miss Priya, the numbers, the information, everything you've seen right now, you can go on to Raveum.com and you'll be able to see it live as we speak. This is the investor portal that I'm presenting right now. So it's just invest.raveum.com, and you can go there, click on Chapel Run, and this deal will be going live in the next few days. You'll be accepting investment. We're just launching this deal right now, as there are a lot of early bird investors who are investing larger ticket amounts. You can go scroll down, click on the document section, and get every document, the one that you saw Julian present, the returns, the risk factors here itself, the details, the finance, the rental comparables to what Julian mentioned, all can be seen online right now and on your mobile applications as well. So, and Mr. Arav asked a question. I can see the numbers are in dollars. Could you let me know how they would look like in rupees? I can do one better for you. If you go on the invest.ravium.com web portal right now, click on the finance tab over here, you will see your IRR calculator. So over here, please select the currency you're investing with. This presentation and this deal is right now only available to our Indian customers. So you click on INR, click on how much you want to put your investment down as, click the target IRR. So for this deal, Julian said a 16 IRR. So let's just say 15% to be conservative. 4.5 foreign exchange rate. That is actually the amount the rupee is depreciating year over year. You can see your net return adjusted for the Indian rupee right here. So your equity multiple, assuming a 4.5% rupee depreciation, will be 2.51. So a little over doubling your capital over the whole period. If you have any follow-up questions, do let me know. I'll be happy to answer them as we go forward. Thank you, Mr. Arav. Yeah, so just to ensure we all are on the same place, if you would just come into the fundamentals of the deal, Chapel Run, it's a strong 16% targeted net IRR with a very proven accredited sponsor, Colony Hills Capital. The clear path to NOI growth is there. There are a couple of immediate next steps you can take to participate in this race. And I'm going to just go over the next steps over here really quickly, and then we'll go back to answering a few more questions for you. I think there are a couple of family offices and private equity firms that we can do a couple of one-on-ones with right now as well. So first, I want to go ahead and ask my investor relations and operations team to quickly speak up and introduce themselves. These will be your point of contact. They are based in India. They're here with you to make you understand your local remittance, structuring nuances in and out, and they will be your direct point of contact. So really quick, I would like to begin with our investor relations senior associate, Ritik Raj, to just introduce himself. I think people are already aware of the team. They've already interacted with everyone I'm going to mention, but I'd like to take this chance anyway.
Hello, everyone. This is Ritik here. I'm the investor relations rep at Raveum. So I'll be the point of contact for anything associated with the particular deal. Some of you might be in touch with me, Manav, or my associate Ryan. So we will be circulating a form for you that you can fill up, and that particular form has our Google Meet where we can set a one-on-one call in order to discuss the entire depth of the deal.
Thank you so much, Ritik. Ryan, why don't you go next?
Hi everyone. Am I audible?
Yes, you're audible.
Yeah. So I just want to thank everyone to join, first of all, joining the meeting. And I have contacted some of you, and they have been showing up. I'll be also texting the form on WhatsApp, and I'll be giving the details, and I'll be sorting all the queries that you have as well.
Thank you. Yes.
This is Manav from Raveum, and I'm the operations rep. Any coordination or any confusion or clarity you need from here, I will be your point of contact. Obviously, I have spoken to some of you, and I will be sharing the forms and each and every detail that is associated with this particular problem. So happy to connect with you all.
Thank you so much. So yes, guys, these are going to be your main points of contacts on the ground. Please do make sure to fill in the Google form link. I will ensure it's put in the chat right now again. Ritik, if you can put that in the chat again. If you fill it out, we'll follow up one-on-one with you right after this call. There are a few more important questions that have come in the chat that I would like to answer. So before we get to those, do make sure that reviewing all the data points and anything else you can find on the Raveum application and the investor portal, fill in the Google form chat. And now let's just open it up for Q&A For those of investors who don't have questions, I would still recommend hanging on, as a couple of questions that might be interesting for you may come up. So Mr. Dheeraj just asked, is this project approved under the ODI process by RBI? Yes, Mr. Dheeraj, if you're investing above $250,000, you may use the ODI process to invest. However, as with all our previous investments, we use the LRS itself, and we use purpose code S0001, which is a capital account transaction. We have a very good relationship, and our private banking partners, Kotak Mahindra Bank, and they will be coming down to your house and ensuring all the paperwork is approved directly via them. There's a question for you, Julian, here from Mr. Harsh. And the question is, what are the odds of not hitting the rental yield numbers or the sell numbers?
It's a great question. So I peeked and I saw that question while you were giving those intros. So I wanted to show, can everyone see this Excel model? It's probably taking me, it's coming up in a moment. Can everyone see this? Okay. So this is actually was downloaded, exported rather, from Novogradac. Novogradac is you guys can Google them. They are the go-to institution that the local housing authorities use to determine annual rent limits for affordable housing properties across the United States. Okay. So this is for Chapel Run. I downloaded this yesterday in prep for this. You can see what the rents were at our property, the max rents were in 2020. You can see how they've increased every single year. Every year they've gone up. And they've also included...
Could you zoom in a little bit? So
yeah,
you could...
sure. Yep, absolutely. So you have 1-bedroom rents, 2-bedroom rents, 3-bedroom rents, 4-bedroom rents. Okay, this was in 2020, 2021, 22, 23, right? You can see how they just have gone up. They're also projected to continue to go up. Why is that? Because it's tied to the Atlanta economy. It's tied to the average median incomes in and around Atlanta. So if the economy is doing well in Atlanta, people are earning more money, people are moving to Atlanta, et cetera, those rent limits go up. So the question that was asked is, what are the chances of hitting the yields that were projected? We feel very good, very likely, just based off of what's happened while we've owned the property to the rents and what we believe strongly will happen to the rents in the future. And then also the whole value add feature that I told you guys about, which is replacing the property manager, refinancing the debt. Both of those will reduce the operational expenses drastically. Then you mentioned the sale. Yeah. We feel, like I said, very conservative about our sale number at a 5 3/4 cap rate, because properties right now in the area are trading at 5 to 5.5. So 5 3/4 is conservative. For those of you who aren't familiar with the term cap rate, it's thrown around a lot in real estate. It's a very simple equation. It's taking the net operating income of the property, meaning the remaining cash flow after deducting expenses, and dividing that number by the purchase price. So it basically tells you what your yield is on the property. But in real estate, we use it very often as a gauge of value, right? So if that number increases, if the cap rate increases, typically that means the value comes down. If the cap rate decreases, the value goes up. So by us using a 5 3/4 exit cap rate in year 5, when properties of similar stature are trading or selling right now at 5 to 5.5, that means we're using a reduced or depressed value on sale versus what it will probably actually sell at. So we're being conservative even in our exit forecasting and estimations.
Great. So Julian, could you just rename the tool that you had spoken about, Novogradac, so people can check it out themselves? I think Mr. Harsh was looking for it.
I'll throw it into the. I'm going to throw it into the chat right now.
Okay. Thank you so much. All right. Thank you so much. So Mr. Harsh, I assume that's what you were asking for. If not, do let me know and we can clarify. Perfect. So let's go towards the next question that we would ask. There was a question here. What is the GP equity mentioned in uses? Why? What is that? What is that reference to? Could you help us figure it out?
Yeah, sure. Great question. Let me share the screen and I'll walk you through that. Okay. So it's coming up. So in the property right now, we have our, here on this right side, we have uses. So we have our in-place debt. This is the floating rate debt that I mentioned a few times that we're going to be refinancing with a fixed rate debt.
Yes.
We have our current JV partner, our current equity partner, who's the group that I mentioned in the beginning wants to sell, right? They have a fund that they need to close out. This is one of their legacy properties, one of their last properties in that fund. They want to sell. We don't want to sell because we obviously see there's a lot more value add here. So we have a different agenda than they do. But we still have our own equity in the deal. The GP equity is Colony Hills equity. This is the money that we've invested into the deal. We put this money in when we purchased the property. That is staying in the deal. We're not recapping our own position. We're keeping our position in the deal. So you can see it flows over to the left side. The new equity of 7.2 million would be all of the investors coming in through Raveum. That 7.2 million is going to go towards a few different uses. Kabir, I believe you've made the Excel pro forma available on the platform for
Correct.
people to look at the details. The additional money coming in is going towards, so it's taking out our existing JV partner. It's going towards working capital. We have to purchase a new insurance premium, and we're going to have to put aside a new set of taxes and reserves. There's also going to be closing costs associated with this refinance recap, legal expenses. The new lender is going to have a fee, right? A 1% fee on their loan. So we have to pay for that, et cetera. So that's the delta between the current JV partner of 6.8 million and the new equity coming in. The $400,000 delta is what that's being used for.
Great. Perfect. Julian, one more question for you from Ms. Mansi. What does it mean, cash to GP and rollover? I think those names mentioned. Could you just help clarify that a little bit?
Were those mentioned? I don't think I mentioned those. Were those mentioned in the Raveum?
It probably was mentioned on the pro forma when they were doing their diligence, cash to GP and rollover. If Ms. Mansi, if you would like, you can always unmute and clarify your question directly so that we may better address it. Or type it again in the chat. No, there's no restriction. Okay. Well, Julian, in general, cash to GP rent, it might be rent rollover. That probably is what it referred to. Okay. All right. Perfect. All right. So we have answered the question. Julian, was a clarification to your earlier question.
Oh, good. Okay, great.
Perfect. All right. There's another question over here that was asked that I'll take from Mr. Yash. Could you please explain the investment structure for Indian investors? Is it via a GIFT City feeder? So, Mr. Yash, we actually pride ourselves on not using feeder structures in India. We want to ensure that all your investments come under the purview of the SEC directly, rather than the RBI and the Security Exchange Board of India solely. So all your investments require direct remittance into a Texas-based LLC that comes under Regulation S of the SEC and or Regulation D506C as well. So the exact entity setup and structuring of the capital and movement, you can also have a one-on-one call with our finance associate, Shreya, who's on this call here. Shreya, you can quickly say a quick hi if you feel like it. But
Hi, everyone.
Yeah.
If you have any queries relating to taxation or how the funds will move from India to US, I will be your POC.
Great. Yes. But to answer your question again, was we're not using gift city feeders. You're doing direct remittance into a US-based entity where you will be allocated units. You will have all the documents for that also on the Raveum map and the investor portal as well. There is a couple more questions from Mr. Harsh, which is, can we get access to the investment memorandum of the structure of the investment? what would be the management fee, the hurdle rates, and the carry. So, Mr. Harsh, all this information, again, like I mentioned, will be viable for you on the Raveum platform right now. If you go ahead and download the pro forma and the offering memorandum, you'll be able to get access to all that information. If you need something else extra beyond that, feel free to just go ahead and fill in the Google form link that Ritik has pasted in the chat, and we'll follow up with you one-on-one to ensure you have all the information you need.
I'm also happy to answer really quick, Kabir, if you'd like. The carried interest, as I described before, is a 70-30 over an 8 IRR. So on sale, once all of the investor members achieve an 8% IRR, meaning return of capital plus an average return of 8%. Let's say they're, just to use an easy number, this isn't the precise one, but let's say there's $1 million left on the table. 300,000 would go to Colony Hills as our carry. 700,000 would go to the investors after they've already gotten an 8 IRR.
Yeah. And to be careful, Julian, Colony also has $4.5 million in this deal.
Correct.
Yeah. So we're raising 7.2 million. More than 50% of what Colony is raising has been invested by them already in this particular project. There's also a question, do you have a T12 operating statement? Now, I don't think that's on the application yet, but Julian, if you could provide that to us, we'll be happy to make sure that you guys get access to that as well, Ms. Mansi.
Sure.
I think there is a question by Mr. Harinder that requires a little bit of nuance. Mr. Harinder, if you would like, you can just hang back at this call and I will personally speak with you, with Ritik, and we'll be able to answer your questions about your settlements in the US and how we can actually help make sure we can make that happen. Beyond that, are there any more questions regarding the deal that Julian can answer or we can speak about? Okay. And also, feel free to always unmute and speak. There's no reason to always use the chat. You should be comfortable asking us questions directly. I do see a few responses in the Google form already. So do remember, next steps from here is simply to go ahead and fill in the Google form link. If you are interested and you want to express investment interest, we'll be sure to reach out to you immediately, as we expect this deal to be a short one. And I think because of the edge that we mentioned, which is the fact that rent restriction will be lifted, we're seeing a lot of investors get interested. So do go ahead, fill in the form. The quicker you do it, the quicker we can get to you and to make sure that your interests have been expressed. And I think that's it. Thank you so much for everyone joining us here today. Thank you so much, Julian, for taking time out and addressing all our investors. I think this is the first time you're speaking with them, even after the last project we did Encore. And yeah, thanks everyone. I'll be hanging back if you guys want any one-on-one questions. Me, Ritik, and Shreya from our team will be hanging back. The rest of them, feel free to go back and enjoy the rest of your evenings and enjoy your 9 p.m. on a Tuesday. I'm sure you have work tomorrow, so you guys feel free to leave.
Thank you very much.
All right.
Take care.